Welcome, everyone. Today, we're doing a deep dive into something really shifting the ground under global trade. Those new U.S. tariffs slapped on the Chinese economy early this year, 2025.
Yeah, it's a big one.
We've got some solid analysis here looking at, how these trade walls are actually playing out in China. Our mission really is to get past the headlines. We want to understand the big economic shifts, maybe some surprises too, that are happening because of these tariffs.
It's definitely a time of rapid change. Getting a handle on the dynamics is key.
Absolutely. So President Trump's back and boom, major tariffs. We're talking up to 145% on lots of goods.
And even higher on some specific things, right?
Exactly. If you add in the old tariffs, things like electric vehicles, medical syringes, they're facing like 245%. It's huge.
Wow.
And China, well, they hit back 125% on U.S. goods. Predictable, maybe?
Retaliation was always on the cards, yeah.
Okay, so to really get our heads around this, let's maybe start with the immediate reaction. Q1 2025. What happened right away?
Well, this is where it gets kind of interesting. The first numbers we saw for Q1 2025,
Yeah.
despite these huge tariffs going up, China's GDP actually grew 5.4%.
5.4. But the forecast was lower, wasn't it?
Yeah, the consensus was around 5.1%. So it actually beat expectations initially.
Huh. That is a surprise right out of the gate. And
Yeah.
there's data backing that up.
Oh, yeah. Retail sales, for instance, in March, they jumped 5.9%. The prediction was more like 4.2%.
Okay, significantly higher.
And industrial output surged to 7.7%. Again, much better than the expected 5.8%.
Right.
Even urban unemployment ticked down slightly to 5.2% in March, and fixed asset investment was up 4.2%.
So quite a bit of positive data points there, despite everything. What do we make of that initial burst?
Well, it suggests, a certain level of immediate resilience in the economy.
Yeah.
But, and this is really the crucial point you need to grasp, the experts like Morgan Stanley are warning this is probably not going to last.
Okay.
They expect growth to weaken maybe quite quickly from Q2 onwards.
And why is that? Just the delayed tariff impact?
Partly, but also the feeling that getting these tariffs lowered anytime soon is, well, it's looking pretty difficult. Near-term negotiations seem unlikely to succeed.
Right. So that initial upswing might be kind of a temporary blip. Because the revised forecasts looking ahead for the whole year, they paint a much different picture.
That's exactly right. The big financial institutions have all been revising their 2025 GDP growth forecasts downwards significantly.
Like who? What are they saying now?
Okay, so Goldman Sachs, they've cut their forecast to 4%. They were at 4.5% before.
Down half a point.
Yeah. Citi and Natixis, they're both now predicting 4.2% growth. And UBS, they're the most cautious, forecasting just 3.4% for the year.
3.4%? That's quite a drop from where things seem to be heading. What's the main reason they're citing for these downgrades?
It really comes down to the tariffs. It's the core factor. Goldman, for example, they estimate that these higher U.S. tariffs going up to 125% on average from around 11%, before that alone could shave off 2.2 percentage points from China's GDP growth this year.
Wow, 2.2 points is huge.
It is. They do acknowledge Beijing might, try policy measures to counteract it, but they don't think it'll fully offset the hit.
And UPS is even more pessimistic.
Yeah. Their view suggests an even bigger negative impact, possibly over 1.5 percentage points, or 150 basis points, as they sometimes say.
Which really throws a wrench in that official government target of around 5% growth, doesn't it?
It makes it look very, very difficult to achieve. Precisely.
Okay. So if the overall growth picture is dimming, let's talk about the sector that's probably feeling it most directly. Exports.
Yes, exports are definitely right in the firing line. It's the most immediate channel for the tariffs to bite.
And the forecasts reflect that, I assume?
They certainly do. UDS, again, they're predicting exports to the U.S. could potentially drop by as much as 2/3 in the coming months.
2/3? That's massive.
It is. And overall, for China's total exports globally, they see a 10% decrease in U.S. dollar terms for 2025.
Okay. Others seeing similar trends.
Nomura also revised their outlook. They were initially forecasting flat exports, but now they're predicting a 2% decline for the year.
That's quite a swing, too. And exports were really important for China recently, weren't they?
Incredibly important. Goldman Sachs research pointed out that strong exports were basically the main driver of China's growth back in 2024. They figured it contributed something like 70% to the overall expansion.
70%. So a slowdown there is a really big deal.
It's a huge deal. It'll have significant knock-on effects. The general thinking is that we'll see the full force of this from maybe Q3 2025 onwards.
Why the delay?
Well, existing contracts need to run out, and U.S. companies need time to actually adjust their supply chains, find alternative suppliers, that sort of thing. It takes time.
Got it. So Chinese exporters are definitely bracing themselves. Okay, another area getting a lot of headlines, and the numbers look pretty stark, is foreign investment.
Yeah, foreign direct investment, or FDI, the figures there are quite dramatic.
How dramatic?
Well, FDI into mainland China in 2024, it hit a 33-year low, just $4.5 billion net.
$4.5 billion. After what kind of previous numbers?
Compared to 2023, that's a 90% drop. 90%. And the peak back in 2021 was $344 billion.
Okay, a 90% drop from the previous year is staggering. Has it continued into 2025?
The trend seems to be holding. January 2025 saw the lowest FDI level in 4 years. It was down 13% compared to January last year. You can really see this as like a major vote of no confidence from global investors.
A signal about perceived risk, perhaps.
Exactly. A big shift in how they view the risks versus rewards of putting money into China right now.
So what are the reasons being given for this huge capital outflow?
The official line from China's Ministry of Commerce points to a mix of things. A sluggish global economy, sure. Geopolitical tensions, definitely. Rising protectionism worldwide, like these tariffs.
Makes sense.
They also mentioned multinational companies rethinking their strategies in key areas. Cars, machinery, clothing, that kind of thing.
And what about foreign businesses already there?
Well, a recent AmCham China survey, that's the American Chamber of Commerce, found over half of U.S. firms expect U.S.-China relations to get worse. And a record 30% are either thinking about moving operations out of China or have already started doing so.
30%, that's significant.
It really is. Geopolitics creates uncertainty, right? And protectionism, like these tariffs, makes investing there for export less attractive. It all feeds into it.
So it's the tariffs themselves, but also the whole climate they contribute to. Okay, what about China's big safety net? Its foreign exchange reserves. Have they taken a similar nosedive?
Interestingly, no. Not nearly as dramatic as the FDI drop. There has been a decrease, but it's much more contained.
Okay, what are the numbers?
By the end of December 2024, the reserves were at about $3.2 trillion. That was down roughly 1.94% from November and down about 1.1% compared to the end of 2023.
So a dip, but not a plunge. Why the difference compared to FDI?
China's State Administration of Foreign Exchange, SAFE, they call it. They put it down to things like changing expectations about interest rates in major economies, new economic data coming out, the U.S. dollar getting stronger, and global asset prices falling a bit.
Right.
The fact the reserves held up much better than FDI suggests Beijing has been pretty effective at managing capital flows, despite the pressures.
That's an important distinction. Okay, we can't really talk about China's economy without touching on real estate. That sector's had its own long-running issues. How are these new tariffs affecting that situation?
Yeah, the property sector woes continue, and the tariffs don't help. They basically add another layer of economic uncertainty, which weighs on confidence.
And the numbers still look weak.
They do. Real estate investment in Q1 2025 was down 9.9% compared to Q1 last year.
Still falling.
Yep. And if you look back at 2024, prices for existing homes fell 7.5%. New homes fell 5.5%.
And compared to the peak a few years ago.
Even bigger drops.
Okay.
Compared to the peak in 2021, existing home prices are down nearly 16%, and new homes almost 9.5%.
Ouch. So that downward trend is pretty entrenched. Any light at the end of the tunnel there?
Well, UBS is forecasting that maybe the rate of decline in sales and new building projects might slow down this year in 2025. And they think stabilization could possibly happen in 2026.
Helped by government support, maybe?
Potentially, yeah. But as Hao Zhu from Guotai International put it, this growing economic uncertainty stemming directly from the tariffs just makes predicting anything about China's overall economy much harder.
It definitely sounds like a complex picture with a lot of challenges.
Yeah.
But amidst all this, the tariffs, the FDI drop, the property issues, are there any bright spots, any sectors doing well?
Yes, definitely. And this is important. We are seeing real resilience, even strong growth in certain high-tech areas.
Like what specifically?
Think the digital economy, AI, biotech, aerospace, and especially renewable energy. That's a big one.
Renewables, how so?
Get this. In just the first 9 months of last year, solar power generation capacity increased by a massive
140%.
140%. Wow. Yeah. And by the end of 2024, China's total renewable energy capacity, wind, solar, hydro, actually overtook its coal and gas power capacity for the first time ever.
That's a huge milestone, isn't it?
It really is. So these high-tech and green sectors are providing a bit of a counterbalance to the tariff impact.
And it fits with their broader strategy.
Absolutely. It reflects China's ongoing strategic push towards an economy driven more by innovation and sustainability, less reliant on just traditional exports. It's a deliberate pivot.
Okay, so China's facing these headwinds, but it also has these areas of strength and a clear strategy. How is the government actually responding to this whole complex situation? What are they doing?
Their response is pretty multifaceted. They're tackling it on several fronts.
Okay.
First, on the trade front itself, retaliation and negotiation, I guess. They put those 125% retaliatory tariffs on U.S. goods. That was a clear signal.
A tick for tat.
Right. The Ministry of Commerce said, they don't need to react to every number game, but they will act firmly if China's interests are harmed. And Ambassador Xi Feng basically said the same. We don't want a trade war, but we'll hit back if necessary.
So, standing firm on trade, what about supporting the economy internally?
Domestically, the big push is to boost internal demand and public investment. We saw continued spending on infrastructure and manufacturing last year, up 5.8% and 6.3%.
Okay.
And they've expanded programs to encourage people and businesses to trade in old appliances or equipment for new ones, trying to stimulate spending that way.
And maybe more stimulus coming.
Goldman Sachs thinks so. They see potential for more policy easing, maybe interest rate cuts or more government spending to prop things up.
Right. And given that huge FDI drop we talked about, what are they doing specifically to try and get foreign companies investing again?
Yeah, that's clearly a major focus. They rolled out a big 24-point action plan back in August 2023. The idea was to improve market access, especially in finance and high tech.
Did that continue?
Yes. Then there was another joint 20-point plan this February. Plus, ongoing efforts to just make the business environment better, cutting red tape, protecting intellectual property more strongly.
Trying to improve the feel for foreign firms.
Exactly, and expanding pilot programs where foreign companies can have 100% ownership in certain sectors. Ling Ji at the Ministry of Commerce keeps stressing, China's still committed to opening up and wants that long-term foreign investment.
Interesting. Now, you also mentioned China's outward investment is increasing. How does that fit in?
That's another important piece of the puzzle. Their investment abroad went up 11% in the first 11 months of 2024, hitting almost $129 billion.
Why do that now?
Well, it serves a few purposes in this environment. It lets Chinese companies maybe get around some trade barriers by producing goods elsewhere.
Like in Southeast Asia.
Exactly. It also gives them direct access to new growing markets. We're seeing a lot more investment going into ASEAN countries. Vietnam, especially, has become a really key destination. It's now the third largest recipient of Chinese outward investment.
So kind of a strategic diversification move. And lastly, we talked about those strong high-tech and green sectors. Is the government actively pouring fuel on that fire?
Oh, absolutely. There's a very clear, deliberate strategy to accelerate development there. You see it in things like new competitive AI models like DeepSeek that came out early this year. You see it in the huge surge in renewable energy investment we mentioned. And the government has explicitly prioritized things like new energy vehicles, NEVs, solar panels, lithium-ion batteries.
So-called new three industries.
Precisely. These are seen as absolutely critical for the future, reducing reliance on old-style exports that are vulnerable to tariffs and building real global competitiveness in the industries of tomorrow.
Okay, so if we try to pull all these threads together, it really feels like there's this tension, doesn't it? We saw some surprisingly resilient numbers initially.
Right, that Q1 GDP growth.
But underneath that surface, there are these pretty significant long-term challenges building up. Headwinds, as you called them.
That sums it up really well, I think. The big hurdles are definitely there. Exports likely falling. That sharp FDI drop is worrying. And the property market is still working through its issues.
But at the same time, you've got these glimmers of hope, or perhaps signs of adaptation. The growth in high-tech and green energy is real.
It is. And there's the potential for domestic consumption to pick up some of the slack, plus all those policy responses the government is trying.
Yeah. And we have to remember the bigger picture too, right? This isn't happening in a vacuum.
Absolutely not. You've got the whole U.S.-China strategic rivalry playing out. You've got rising protectionism globally, but also opportunities emerging in places like ASEAN and other developing markets.
And that freeze in trade talks, the China plus one idea where companies look for alternatives.
All part of the landscape.
Yeah.
And you see tangible shifts, like trade between China and Vietnam booming over $260 billion last year. Things are definitely rearranging.
It is certainly a lot to track. So maybe the question for you, the listener, to ponder is, what are the really long-term consequences of these big economic shifts going to be for global trade, for innovation, and maybe thinking ahead, what new parts of the global economy might actually gain prominence because of all these pressures? Definitely something to keep an eye on. Thanks for joining us for this deep dive today.